Hello, everyone. Welcome to This Week in Economics with Robert Wenzel. I'm Robert Wenzel. This week, the topic is why a wealth tax is a horrific idea. Elizabeth Warren has introduced into the United States Senate a bill calling for a tax on the wealth of people who have net assets of more than $50 million. The bill calls for a tax of 2% on wealth above 50 million. And for billionaires, the tax goes up to 3%. This is a horrific idea. Let's discuss this. The idea that you would tax people who are producing goods and services and have become wealthy that way is a failure to understand how a society grows. Now, I hasten to add quickly, there are two types of people that become billionaires. You've got billionaires that are what would best called crony billionaires, crony capitalists. And what they do is they work in cahoots with government to either eliminate competition, uh, make regulations which force us to only buy goods and services in a certain way, or they get the government to buy directly their goods and services. That should be eliminated by getting the government from doing those types of things. Eliminate anything the government does that benefits those who are now in cahoots with the government. Just eliminate that connection completely. But there's another group of billionaires out there. And these people, for the most part, are obsessed with making money. Money is very, very important to them. We hear often the idea that there are billionaires out there who leave small tips uh, at a restaurant, and that's because every penny is important to them, and they're always thinking about how to produce goods and services, um, more goods and services that we will buy from them. And if we're buying from them, that means whatever they're producing, we want. And so I want these kind of billionaires out there thinking all the time about ways they can produce goods and services that I want. I want them to be obsessed and free to do this because they're really helping all of us out. To tax them is insane. By becoming billionaires by producing goods and services, they've demonstrated to a significant degree that they are very, very good entrepreneurs about understanding alertness where there's opportunities, how to put goods, um, land, labor, capital together to make products that we want. To take money away from these people who are best at using capital is quite frankly insane. Let me give you an example. Let's assume there's a small town that has about 6 builders in it, and one of them is far better than the others. He knows exactly how many laborers to use on a project to get it done swiftly. He understands where to get lumber cheap, and he knows how to structure it out and map it all out. So he builds houses he does it quicker. He does it with that the houses are better houses and they're larger houses, and he can come in at lower prices than the other builders. And he makes a lot of money because he's able to do this. Now, why would you, if you were in this town, tax this guy the most out of everyone because he's making more money? If you tax him, he's either got to take money out of his bank account to pay the additional tax, and that means he may shift more later or have less money available to buy labor and lumber and all that kind of stuff. Or he may even have to sell some of his goods. He may have to sell some of his hammers and ladders and trucks and whatever else he needs to build his houses. Why would you want to force the guy that is the best builder of houses to liquidate some of his assets that build houses? That's insane. That's what a tax on a billionaire is, who is buying building entrepreneurial businesses that provide us with goods and services. He's very, very good at it. and you want him to have as much capital as he earns. You don't want to take it away from him. He's the guy that knows what to do with it. And he's already demonstrated he's obsessed with it. He's thinking about all the time how to make more goods and services. That's the guy you want. To take it away from him makes no sense. So that's the basic argument. I mean, it's just pure evil. Now, what's remarkable is there's an article in Barron's magazine. Barron's is a weekly investment magazine that is supposedly one of the foundations of free market economics. But what he does in this, there's an article in here, uh, goes completely against free market economics. The headline says it all. Why Warren's wealth tax could be good for investors. Let me read that again. Why Warren's wealth tax could be good for investors. Now, this is coming from a magazine that's supposedly free market oriented. Now, the author of this article, actually, I consider him a technocrat. He's very, very similar to Milton Friedman. Milton Friedman was very, very good on free markets in many, many ways, but he was a technocrat when he came close to advising government. When he was close to policy making, he gave some of the worst recommendations. He never pushed for elimination of government anywhere. He was a technocrat making, actually, in his case, he was making the government more efficient. I'll in a future post, I'll discuss that. And I actually think his ideas with regard to technocratic efficiency really dominate his role as an economist, and it makes him a very, very bad economist. He was very, very good at defending free markets in certain ways, but he was worse when it came to being a technocrat. His stuff still haunts us to this day in many, many ways. But anyways, this guy, the author of this paper, closes after he's justifying the wealth tax. He says, like all taxes, the proposed fee is a form of theft. I mean, that's amazing. He spends a whole paper discussing the wealth tax and just supporting it, sort of arguing why it's good from a technocratic perspective. Then he tries to get off the hook by saying all taxes are theft. Well, if all taxes are theft, what you should be doing is arguing against them, not making silly arguments in favor of an especially destructive tax, which the wealth tax is. But let's delve into his arguments as to why he thinks the wealth tax is a good one. He starts off by saying, I was initially skeptical of taxing wealth rather than income when Warren first proposed doing so in 2019. Now, first of all, this is misleading because Elizabeth Warren isn't talking about taxing wealth as opposed to income. She's calling for wealth tax on top of the taxes that already exist. So there's no idea here about less taxes anywhere or a shift in taxes. She wants more taxes. She wants to expand how much government is spending. And one thing I should add here to cover inheritance taxes. When we're talking wealth taxes, we're talking wealth of the initial entrepreneur that's actually building the business and maybe people that inherit the business. So the argument is most strong against the wealth tax for the entrepreneur that started the business. I mean, he's demonstrated entrepreneurial ability, great entrepreneurial ability. But what about after he dies and it's inherited? Well, he may have taught his the next generation how to handle a business very, very well, and they may continue exercising their skills similar to the way the founder did. So in that case, there would be absolutely no reason to tax them. On the other hand, you might find someone that's a playboy, has no interest in business, no skill, no aptitude for it. And you know what's going to happen to him? He's going to be like a consumer with all that money. He's going to, as they say, drive it into the ground. So we don't have to worry about his capital getting distributed to the common man. It's going to happen. I hint to any of you that know the guy that has no aptitude for business, but just inherited a lot of money, hang around that guy. You're going to go to some incredible parties, have a lot of fun. If you're shrewd, you're going to figure out how to get some of that cash flow going your way before he spends it all. But that money will go out to the common man quickly. There's no need for government to disperse that money. That's going to happen very fast. You're going to so there's three people here. There's the founder who created the whole thing, who obviously has the skills. There may be a second generation that um, also has those skills because they're taught well, or you might get the um, playboy who's going to run it into the ground and it gets distributed anyway. So one way or the other, things work out with that. No need for government, none whatsoever. Okay, so anyways, let's go on. The author here states, by raising the hurdle rate that the wealthiest Americans need to earn on their investments, the tax could encourage a productive reallocation of capital. Economists Emmanuel Saez and Gabriel Zuckman estimate that about a third of all assets owned by the ultra rich are invested in low yielding deposits and bonds. Okay, first of all, Saez and Zuckman are socialists. They are as anti capitalist as you can get. They are just terrible, terrible economists. They're always promoting some kind of way to rip down capitalism. They don't understand it, and they're just anti. They hate the fact that life is about inequality. There is no equality in the world, and they somehow hate that fact and are trying to change that. Good luck with that, guys. But anyways, uh, the idea there's a misallocation of capital because entrepreneurs who have made a lot of money keep it in low yield deposits or bonds is bizarre. Remember, these are entrepreneurs that are very, very skilled. They understand how to allocate capital. That's how they became billionaires. If they're putting money in low yield investments, that's really a place where they consider the best use of a portion of their money. And remember, money that's put in a bank isn't just sitting there. It's uh, given to home builders, help finance the building of homes. Commercial banks, I give it to different businesses, small businesses, medium businesses. You might have some that finance the mortgage market, which keeps the mortgage market going, the housing market going, a liquid market for houses. What's wrong with that? Why? How is this guy going to step in here and tell us that those are not good investments, that they're misallocations of capital, and that they should be moved into higher risk stuff? Remember, he's telling billionaires how to allocate their capital, that it's being allocated improperly, and that he's got the ideas. This is a central planning, technocratic mentality that Hayek wrote about in his book, The Fatal Conceit. It's the idea that you can have this grand vision and everybody should do things the way you see it versus allowing the free market to just have different people go in different directions. Some are willing to take risks depending upon where they are in life, their risk profile, and other people don't. What is wrong with that? There's no misallocation there, none whatsoever. What the tax does is it shrinks the amount of money that is in the capital sector. Now, remember, government will also attempt to say that they're investing money or maybe putting it in highways as an investment for infrastructure and all that. This is what really goes on. If money is to be used in a capital way in the free market, it will go there. There's no need for taxes to create capital flows. What really happens with money that's taxed is it's money that goes into the consumption sector because it's money that's being used by politicians, A, either buy votes by where they spend the money, or B, to direct money into areas where the lobbyists are pushing them to put it. So they can continue to be, so the politicians can continue to be wined and dined and sent on junkets and whatever. That's where all political money goes. It's all consumption, regardless of what they say, whatever their justifications are. That's what happened. It has to be considered consumption. So that tax, as opposed to just adjusting some kind of allocation of capital that's supposedly misallocated, according to our central planner technocrat here, what's really doing is it's shrinking the capital and therefore decreasing the amount of capital available to create goods and services and decreasing our standard of living. Now, but again, our essayist here says that it's a waste for both the ultra rich and society as a whole. So he's now just coming out and saying the allocation that the ultra rich make is not correct, and he's got a better idea of how it should be done. Now, his next reason for justifying the tax is, finally, the proposal would lead to better data. What a nightmare. The problem with government involvement in the economy is largely based on data collection. You do not want to increase the data. And what he means is that if there's a wealth tax, it means there's going to be a whole bunch of new government bureaucrats out there looking at the assets of the super wealthy to determine how much they're worth, what form they're in, whether they're liquid, not liquid, whatever the case might be. And he thinks this is a good thing. There's an economy, a gentleman that was Secretary of Finance in Hong Kong when England controlled Hong Kong. In between 1961 and 1971, he was the financial secretary. And he would not allow GDP statistics to be kept for Hong Kong. Everybody credits him with the boom period that occurred in Hong Kong. However, he never allowed GDP or any other statistics to be calculated about the economy because he said it just sort of fed the technocrats so that they could look and make these crazy things. Well, this is being misallocated. The capital should go this way. This structure should occur in terms of corporations. Whatever the case might be, he felt that that was a danger. He wanted to keep the technocrats away. And the best way to do that is to not allow the data to be collected in the first place. And this guy is saying a reason for the wealth tax is because more data is going to be collected. As a matter of fact, this financial secretary, Sir John Copperwaith, was asked, what should poor countries do to grow their countries the way you grew Hong Kong? And his answer was the first thing they need to do is stop collecting national statistics. That's how strongly he felt about the dangers of data collection and technicians getting it on their hands. Now, just to show you another example of the problem with data, another justification that the author of this paper uses for the wealth tax is that some of the biggest companies, including Koch Industries, Cargill, Bechtel, Fidelity, and Bloomberg, aren't listed on stock exchanges. So the idea is here that if you get these billionaire companies that are owned by billionaires, they may not have the cash on hand, or they may not want to use the cash to spend to pay for this 2% or 3% tax, 3% tax in the case of these are billionaires. And so what they might have to do is hand over some stock to the government, 3% of their assets to the government, and the government would then sell them and sell the stock to shareholders, and the companies would become public that way. Now, this is another case of just technocratic audacity, arrogance. The reason now different people have different perspectives on this. There are some companies that have raised money to so that they can build their businesses. They have gone public and they deal with shareholders. Others have gone public because they wanted to liquidate some of their assets, liquidate some of the business so that they could have cash to do things with. Both those reasons are fine. But then there are others that want to be private and don't want to deal with shareholders. And these may be the most unique entrepreneurs of all. I mean, if you look at this list, there's powerful, powerful people on here. And they might have visions that are so different from other people. They may not want to have to deal with shareholders and have to explain to them why they're making this business move or what their time horizon is or why they may be taking a small term loss to develop something long term. So they have made the decision on their own to stay private. And there could be extremely important reasons for this that help them grow because they don't have that pressure from outside shareholders. And this guy's coming in and saying, well, this will be good because everybody will have a chance to get involved. Again, it's a technocratic mind, it's blunt instrument thinking across the board. It's like uh, deposit, low yield investments are bad. Where does he get that from? Who knows? Um, Companies that are private and do not have public sharehold, that's bad. There's no distinctions, no ability for some people, if they want to take risk and other people not to take risk with their deposits. There's no distinction between people being publicly traded with their companies and others who decide to keep it private. It's all about, well, this is the way we should go. This is what is needed for the economy. No ability for an individual to differentiate. It's all pushing them in a certain way and arguing that's best for society, which of course it's not, because it it really stifles people, great entrepreneurs, from going in the direction they want to go, regardless if it's flooding the market with conservative investments so more small businesses have opportunities to grow, or whether it's keeping a business private so they don't have to deal with shareholders that may not understand their vision. So that's the story. The wealth tax is terrible, essentially, because it takes money from people who are extremely creative. And that's the last thing you want to do. You want the people that are extremely creative to have as much capital as they've raised so that and created so that they can continue doing whatever they're doing. To take it from them makes no sense at all. And then these other justifications are just technocratic justifications based on someone who is playing the central planner and thinks he knows what's best for everybody rather than allowing the markets to decide. Thanks for listening. Be sure to check out my blog, economicpolicyjournal.com, where I blog Monday through Friday. I talk about economic policy, economic personalities, whatever's going on in economics. If you're interested in economics and what's going on right now, and it's a crazy time, there's a lot going on, that's the place to check out, economicpolicyjournal.com. My podcast here goes up every Sunday at 11 a.m. Pacific time and 8 a.m. Whoops, let me reverse that. At 11 a.m. Eastern time and 8 a.m. Pacific time every Sunday. And I occasionally have a pop-up podcast, and I announce those on the website economicpolicyjournal.com. Thanks for listening. We'll talk to you next week.